The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, I'm Esther Gulius, the tax lady from EG Tax, and we're inviting you to join us for this hour where we're talking about taxes, and we're trying to get you squared away so that you don't overpay your taxes. And we're joined in studio this week with Tiffany Fabian. Hey, Tiff.
Hey there, Esther.
And Christopher Fabian.
Hello, Esther.
Hello, Christopher. All right, so we're going to, like 5 times a year, we just answer emails, and this is one of our email days. So don't call in, although we love to hear what you have to say. During the week, though, you can call us at our corporate headquarters at 632-7886. And why don't you mention our upcoming fall
we have
extravaganza?
We have a fall financial tax forum, and it's just going to be our experts. We're going to have Dennis Kitchen there. We're going to have Jeff Katz. We're going to have real estate exchange, Russ Gullo. We're going to have
some
tax information.
Guys, right?
The financial guys are there. We're going to have a college expert talking about college planning, a Social Security planning segment. So just a lot of information. And then also there'll be a breakout session about taxes, talking to you about tax planning, just about, if you are somebody who takes an accountable plan, a non-accountable plan. So the tax reform, understanding the tax reform, knowledge is power. So we can break it down so you can make it to the most ease for your tax situation.
Don't just look at a two-second soundbite that says, okay, so you can double your standard deduction. Believe me, there's so much more to it. And we want to make sure that you get the most bang for the buck, so to speak. So EG Tax is there in your corner. And again, you can go to our website at egtax.com. We have a wonderful app too, right?
We do.
We have a great app. There's mileage trackers. There's receipts. You can link it right to your QuickBooks. There's, tons of different tools on there. You can get push notifications when tax laws happen, changes made, which we hope they're still making tax changes, but that will make our life so much easier. Ha, ha, ha. But
that's part of what we do. We love helping people.
Yep. Because we're on your side and we know what's going to be the best for you guys. So we're pushing that things do get changed.
Okay, so let's go to our emails. What do we got, Chris or Tiff?
Go on, Christopher.
Okay. We have Eric writes in, can you explain to me why I would want to become a corporation instead of my DBA? I have a small power washing and deck staining business. My gross income is $100,000 and my net is usually around $35,000. All my friends say I should incorporate. Isn't that expensive?
It's really interesting. Normally, when people get advice from their friends over the backyard fence, I say, don't listen to your friends. Mm-hmm. However, I think this time his friends are right. Primarily because we live in a very litigious society. People are, half of the commercials on TV, if you aren't listening to the prescription and the prescription drug commercials, then it's the attorneys are on the phone. On the horn. So you want to make sure, you have to understand there are people that say if you do something wrong that they can hold you accountable for, they're going to sue you. Well, that's one of the benefits of being incorporated. The only thing that you would lose if you haven't committed some kind of a gross negligence is the assets in your corporation. So your power washer is all that's at stake. Because you can open up the next day under another power washing company's name. But if you don't, then your personal assets are kind of hanging out there to be sued. So a great thing is the protection of a corporation.
Mm-hmm. And it's not that cost prohibitive. We do it at our offices and we charge you just simply what the biz filing charges us. And so to do it at our office, versus a law firm, you just mentioned lawyers, it's a lot more cost
Well, you can
savings.
go to bizfiling.com and do it yourself, right?
Yep, and it's not that costly.
So, when we set up people in corporations, we don't make anything. We just absolutely are kind of the conduit. We go online and we fill out the stuff, and that's it. You can do it at home.
Yeah.
Now, then we're not telling you not to use an attorney, but I'm just saying that if you're somebody that's kind of a do-it-yourselfer and expenses are important to you, you don't want to pay, because the state of New York's going to charge you a certain amount of fees, and biz filing for doing the work is going to charge you something as well.
Yep, and
It's
I
not
know.
very- what do they usually?
It's
like
usually
300?
about $300.
Yeah.
And then Chris always teaches me, first you should see if the name is available, right, Chris?
Yep.
And
Well,
then,
that's what biz filing does for you.
Yep, and then you should get,
Then you incorporate.
and
then you get your tax
ID number.
Right.
Right,
And then
but-
you open up a bank account.
Right. The big thing is, well, a lot of I don't even want to say it's a new kid on the block, but it is in regards to business entities, is the LLCs.
Okay.
And that's where you see a lot of people becoming an LLC, and you're like, why did you do an LLC? Oh, to help protect my assets.
Which is true.
Which is true, but the LLC also has a more expensive cost to set up, because you do have the filing fee, you have your advertising fee, because you have to, it's not, hey, I'm open for business, that type of advertising. It's saying that Eric Power Washing has now formed an LLC in New York State, ... And that has to go in 3 different types of newspapers, a daily, a weekly, and a monthly for 6 months. And if you don't do that, then you're not an LLC, so that protection you have isn't there, because a lawyer could break that because you didn't technically fulfill your due diligence to become the LLC. So you got to be really careful when you do become an LLC.
Right. But his friends told him the truth.
To incorporate.
He should. I can't even think of any business that shouldn't be either the protection of an LLC or a corporation. You just never. I mean, wouldn't it be a horrible thing? Your power washer sprayed somebody and their eye popped out. I mean, you just never know.
Yep, yep. And so his
Okay.
friends were right.
All right. So what else we got here?
Well, on the track of self-employed people, I have E.G. Tax. I'm a self-employed real estate appraiser, and I went to a lecture, and they talked about a solo 401k. I remember they said you could put a lot of money into it. And since I inherited some money, this might be a good idea. What do you think, Louis?
Okay, well, I mean, so when you are self-employed, or if you have a business, part of what your ability to do is to set up a pension plan.
Right.
If you have a 401k plan, you have to include your employees in your 401k plan if you're highly compensated, However, if you are the only employee of the business, because you're a solo practitioner, you're entitled to make the maximum contribution to your pension plan plus a match. That comes to over $50,000.
$53,000 a year.
Right. So but you have to set it up. So it's called a solo 401k plan, and it's like anything. I love when people set aside money so they don't pay taxes, but the truth is you have to be able to you don't have to need the money because it's put away. But the great thing is it saves you income taxes, it doesn't save you FICA, and the money's there for your retirement. So a solo 401k plan is marvelous.
Yep, that's right.
And I will tell you, many realtors, they're doing simples, which are good, but and they're doing SEPs, which are better. But really, if you can afford to do a solo 401k plan, it's the best. You can put the most money away.
Yep.
right?
Definitely.
All right, and we're going to take a short break. I'm Esther Golias, the tax lady from EG Tax. Don't call us this week. Call us next week. We're answering your emails. Again, if you want to be part of our show, our email show, you can use us through the website at egtax.com. Ask your tax question, and it'll be on air one of these times. Until the other side here, I'm Esther Golias, the tax lady. Hey, I'm Esther Golias, the tax lady from EG Tax. I'm here in studio with Tiffany Fabian, Christopher Fabian. Don't call in this week. We're answering your emails, but if you want to be part of our email show, you can go to our website at egtax.com, ask the tax lady, and one of these email programs might be your question on air. Until next Saturday, though, then you can call in and ask your questions live. But until then, hey, Chris, Tiff, what do we got?
Robert from Amherst writes, tax lady, I'm a successful real estate professional. Every year I get killed with taxes. What can I expect this year?
Well, some good news.
Good news.
Right?
It doesn't change for you guys.
No, I mean good news because
you get the pass-through. Yeah, that's really good news.
So why don't we explain the pass-through so that he can be happy?
Right. So how the pass-through is going to work? It's going to take your net profit and give you a 20% deduction. It doesn't reduce your income on the Schedule C. Doesn't save you self-employment tax, but it's almost like an adjustment to income, where
It's almost like itemizing, right?
in a way.
It's after. I mean, it's after your AGI, so it's a lot like an itemized deduction.
Right. But it doesn't go on your Schedule A.
No.
So if he makes, we'll say, $100,000 profit from real estating, it's going to give him an extra $20,000 subtraction from income on his tax return.
And this
It'll be interesting to see if New York State follows suit with that.
Yeah.
know?
Yeah, New York State
And
is still
right now, we don't know what New York is
figuring
doing.
it out.
I don't think New York
they're
State
doing
knows.
a lot of kvetching and rocking back and forth.
Yeah,
not knowing
they're
what to
more
do.
worried about the SALT deduction and making it a charity.
Yep. So,
And then don't forget
so
if-
it's really good for you. So especially if you're somebody that does estimated tax payments and this year the 22% bracket, you're going to save $4,400 in income taxes. So that means you get to adjust your estimated payments.
That's
and,
down. Which is always a happy thing.
And going back to who was this
the
again?
other person.
We could go back to the other question that he might want to look into a solo 401k.
That's true.
That was Lewis.
You know, he could put money away, not just in an IRA, not just in a simple, but the 401k, which could help if he has the money, put more money away.
And then don't forget, if we have landlords out there who have rentals with proper profits from their rentals, they would also be privy to that 20% pass-through, which is really nice.
This is a really exciting thing. So if you're a small business owner, whether it's real estate or any small business, 1120S, Subchapter S Corporation, you're going to end up with a 20% pass-through deduction, and it can be quite substantial. If it's $1 million net profit, you get a $200,000 write-off. Hello.
That's good news.
Right?
Yep.
And again, during the week, if you're listening and you think, it's interesting. I was flying with the guy the other day down to Florida, and he said, gee, do you understand the changes in the tax law? And I said, yes. And he said, how come my accountant doesn't? I said, I have no idea. But, I mean, we don't know all the nuances yet. But we understand it? We certainly do. And you want to get ahead of the curveball. You don't want to be left at the gate, because in January it's too late.
Yep. Oh, it is. You got to make the changes now that aren't going to impact your 2018
Right.
tax return.
Okay, what else we got?
I have Al writes in, tax lady, I own a rental property, 25 years, and I'm getting tired of all the repairs and running around that comes along with it. One of my children want to buy it from me. It's worth $175,000, and I'm thinking of selling it to him for $100,000.
Why is that not surprising? Okay.
The arm,
Can I claim the loss of $75,000?
No, it has to be an arm's.
He doesn't have a loss.
All right, go, Chris. You're saying what?
He doesn't have a loss because, first of all, it's
Oh.
worth $175.
Right.
Just because he sells it for what's under what it's worth doesn't make it a loss.
Because of the depreciation.
Right. He has depreciation, and if he's owned it for 25 years, it's basically, depending on new windows, and
Has a zero basis.
has a zero basis. So he's probably going to pay tax on $90,000 of that $100,000.
Right.
So, and that's what we see.
But here's the thing. Let's go back though. If he did sell it at a loss, could he take a loss on the sale to a family member?
And that's where I was going
No,
with the
you
arm's
can't.
length transaction.
It's interesting because my nephew was selling his rental property this year and he said, I think I'll sell it to my dad and take the loss, and then I don't have to do the remodeling. And I said, no, Mark, you can't take a loss when you sell it to a family member. He said, well, why not? And I said, because it's so easy to do on a family member. You know, basically your basis goes to their basis to them, and then when they sell it to a non-relative, then they'd be able to take the loss.
Yeah,
but
and-
you aren't able to take a loss when
Yeah.
you sell
Oh,
it to a
And what
a
Chris says,
family
I see this all the time with people thinking they don't know about adding back all the depreciation. What were you going to say?
I was going to say I had someone who had 2 rental properties. One they sold for a $90,000 profit, and they're looking to move, so they sold another one of them because they don't want anything up here. So to offset the gain, they sold one of their other rental properties to their brother for like $100, thinking they would be able to use the loss to offset the gain and pay no tax. You want to talk about tears in an office?
And that's why you just make a phone call first
Yeah,
and
you
double
know,
check.
I mean, gosh, call us for crying out loud. You know, there's no
Yeah.
charge. We don't
Before-
make you sign up a form. You're going to use this next year. We just don't want.
Before-
It's just such a terrible thing to think that people are giving away money like that.
Before I left the office, I had somebody call and ask me. She said, I have a personal residence that I only lived in for 9 months. I don't like the neighborhood, and I'm selling it. And my neighbor told me I don't have to worry about capital gains. And I said, have you lived there for the last 2 out of 5 years? And she said, no. She goes, but my neighbor was insistent that I don't have to worry about capital gains. And
Well, there is an exception
moving for a
to that
job.
2 out of 5 year thing if it's due to
health.
if it's due to some type of unforeseen circumstances like health,
was not.
Divorce, change of job, but just because you don't like to live there is not one of the exceptions.
Maybe they don't like their neighbor who just gave them wrong tax advice.
Yeah, actually, I sent her to your voicemail because she didn't believe me. So, yeah. But so this is, you just want to make, at least she's doing the right thing. She's calling.
Yep.
That's right. That's exactly right.
Right.
Okay, what else we got?
I got, I have EG. I just recently received a 2017 K1 for the estate of my aunt. Shouldn't I have received this K1 a long time ago? The K1 was for $16,500, but I only received $12,500 from the proceeds. What should I do? Well, it sounds like she's got to amend her return and
Well, it all
add the
depends
K1.
if it's fiscal years. Maybe that's why it came after because if it's fiscal year, then it would be this year that it would go on the 18 return. So she has to take a look at what the fiscal year was.
Right.
But if it was supposed to go on last year, then she would have to amend the return.
Right. And the reason, if it was not, fiscal or not fiscal, the reason it was late for a calendar year is sometimes that happens. Sometimes they ask for
They could have
extensions.
filed an extension.
Yeah.
Right.
Yeah. But she has to
Okay.
amend it and
But in-
and then the wrong amount. What
I
were you
was
gonna
just
say?
going to say, in regards to the 16, if her K1 said 16.5, but she only received 12.5, she needs to call the person who did the tax return and say, why am I paying tax on $4,000 extra that I didn't get?
Right.
If it was legal fees, well, then there should be a note. So then she could, in 17, if she did claim it on 17, claim the legal
But not on 18.
but not on 18. Nope. And that's, and think about that.
Wow.
How long does it take someone to fight Social Security, to get Social Security for disability?
3 years. Can be.
Right?
Yeah.
And a lawyer fee is what, $6,000 they can charge.
Yep.
And then if they were on workman's comp, they don't get all that money from Social Security.
That just made my
but
skin crawl.
in years
But from
past,
now on, it's taxable.
right, years past, you were able to deduct the lawyer fee and the workman's comp offset under the 2% adjustment.
And that's what's so interesting. Everything I read says that they rushed to pass some of these tax laws because they really wanted them done before the end of the year and stuff like that. And they didn't think out some of these things that they closed up. And it's not like they're loopholes. This is just makes sense. Why would you make somebody who's got a settlement of maybe $50,000 or $60,000 they've waited 4 years for Social Security, and the attorney took $12,000? How can you make that not deductible?
Yep.
You know, it's just
Well, now
bizarre.
they're going to be paying. Could you imagine if they got $70,000, they had to give $40,000 back to workman's comp and give the lawyer $6,000, so $46,000.
Yeah.
So they're getting $24,000 out of that $70,000.
Right,
But
and you're saying they're supposed to pay taxes on that?
On that
For,
full
I mean,
$70,000.
hello.
Yep.
So, this ought to be interesting. But in the meantime,
Yikes.
we're going to have to break for news, right, Chris?
Yep. Further news coming up.
All right, I'm Esther Golias, the tax lady from EG Tax. We'll see you on the other side. Hey, this is Esther Golias, the tax lady from EG Tax, and we're so thankful that you joined us today to ask the tax lady if you have any questions. Next week we're going to take your live phone calls, but today we're doing your emails, so I think you'll find it interesting the way that we think. And you can see all the different things in the tax law as we answer your email tax questions. If you want to be part of the email show, just go to our website at egtax.com, ask the tax lady, and enter your tax question, and we'll put you in a future show. Okay, and I got Tiffany Fabian, Christopher Fabian here in studio with me. What do we got? Next.
I've got sign confused. It says, "Hi, EG Tax. I'm a landlord, and I have people who do work on my apartments often. My friend said I should issue 1099s to these people who do work on my apartments. Is that true? I've really never done this. Would this open up a can of worms or a red flag?"
It's so interesting that people always say that. If I start doing it right, is that going to get me in trouble? No. Doing it wrong is going to get you in trouble. Continuing to do it wrong is going to get you in trouble.
Right.
If you pay more than $600 per year per an individual doing work for you, you have to issue them a 1099 form.
Right, because then they make sure they're doing their due diligence, and the guy who did the work is going to have to claim it on his tax
wouldn't
return.
you say if he didn't issue 1099s, he should issue them right now?
He should.
Right.
And especially if he's taken the deduction without any receipts, in the event of an audit, he would lose, and that money wouldn't be deductible. So now if he
you want to make sure if you haven't done your 1099s, do them now. And if you paid more than $600 per person per year for doing work, you have to issue those 1099s, and that would force them to put it on their tax return, because you can't be complicit in them defrauding the federal government.
Right, exactly. And then don't forget this, landlord, there's that 20% pass-through that you might be privy to if you have a profit on your rentals. So make sure you keep track of all of your expenses, and this is just part of doing your bookkeeping.
That's exactly right. Okay, anything else?
Yep, we got Charlie writes in, Esther, I was just approved for my Social Security disability. I need help figuring out withholding on my pension. My wife makes around $12,000 from her job at our kids' school, and my pension is $800 a month. And I will start getting $1,200 a month from Social Security. My 3 children will also get $400 a month each from Social Security. How much should I have taken out of my pension? I don't want to owe.
Okay, so this guy is not going to owe, right?
No, he's going to be very
He's
happy.
going to get a great big refund. Mm-hmm. So he doesn't have to have anything withheld. And that's the other thing is a lot of people think just because you got some income that you have to have withholding. And so but that's not true. The way our tax situation is set up, they actually give you money back if you are of lower income means and you have children living in your home. So in this case, he's got children that are going to get Social Security. It's not going to cost him anything for their Social Security.
Nope.
And he doesn't have to withhold anything.
Yeah, and his pension, he's going to roll that up to wages because he's disabled.
And he's going to get an earned income
And he's going to get
credit.
an earned income credit. So he's in a really good situation.
Yeah.
And it doesn't sound like he's aware of it. So I'm glad you asked the question, Charlie. And you're going to be in good shape
Right,
come
because
tax time.
he'll also have the child tax credit, the additional
Increased.
child tax credit,
Yeah.
which is up to a $1,400 refundable credit. We're not sure on how that's going to work yet. So between the federal and New
He's
York,
looking at about $12,000 probably.
yeah.
Right?
So
That's a lot of money.
he should be very happy next
Very
year.
happy.
Yep, good,
You know,
good,
now,
good.
but here's the question. Does he have to file?
No, but he should.
Because he's under the minimum filing requirement. But should he file? Yes,
Yes.
because our code is written in such a way that they give you money if you are a lower income taxpayer.
Yeah. And of course, the kids' money that they receive from Social Security, they don't have. They would go on their return if they have to
That's
file,
exactly right.
but they are not filing.
Right.
Probably. Yep. Good question, Charlie.
Okay, what else we got?
I've got Sabrina. She said, my job informed me that my position was eliminated at the end of June. They are offering me a nice severance package if I stay until then. I can't contribute to the 401k through the severance. Can I still contribute to an IRA? My income after severance will be $125,000, and my husband is a stay-at-home dad, so he has no incomes. Well, you should do a spousal IRA, is what I'm thinking. So, any ideas for what I can do? Sabrina says.
No, I mean, that's, I don't know if she has contributed to her pension plan this year or not. If she doesn't have a qualified plan, then she can also put money into an IRA as well, right?
A spousal.
Right. But it sounds like she does have a 401k. She just
Okay,
can't
well, if she
use it.
does, then it would be her spousal IRA. And a lot of people don't realize that if you're not working, if your spouse is not working, and you have wages, that you may be able to qualify for a spousal IRA, giving them up to $6,500 as a deduction, right? If you put the money away.
Yeah.
And then also, it doesn't say anything here because it's something most people don't realize, is if she's on a high deductible health, insurance, HSA, she could put money from the severance herself, go to the bank that's holding the HSA,
Get an adjustment.
and add the money to the HSA, so that will be a deduction to her income, which will also lower her AGI.
Very
Okay.
smart.
But but if you think about all the stuff that we say to people, if you do this and if you do that, but the operative word is do. But if you don't do anything, then nothing good happens. So if something unusual has happened in your life, give us a call. There's no charge. We would love to help you, to give you that second look at your situation, because we want to help you.
That's right.
Correct?
Correcto mundo.
All right, what do we got?
I've got Paul from Orchard Park. Is it true, Esther, that New York is allowing us to itemize their deductions when we can on the federal? I have two homes. One is in Buffalo and another in Florida. The taxes on the two of them are $12,000, so it's over that $10,000 benchmark. Does that mean I can deduct $2,000 on New York that aren't able to do on the federal? Good question.
Yeah, but the whole thing is, right now, I mean, we looked at what New York State passed in March, and it sounds like they're going to do some kind of convoluted whatever that was in their budget. But until they really pass some kind of realistic legislation, we don't really know. I am thinking that if it's a second home, it's not going to be deductible anywhere. Would you guys agree?
I would agree with that.
Yeah, because that's the new federal
Yeah, second
law.
homes just look like they're absolutely going to just be an albatross around your neck. That's where I think that you want to convert your second home into an investment property. If it's investment property, then it's going to all be deductible. It just really comes down to another way of thinking about it and making maybe your life a little more uncomfortable because you have to now deal with tenants. But if you do, it's going to make you're going to get rental income. It offsets the expenses of the house. You're going to end up with a deductibility of your property taxes, mortgage interest, travel, insurance, and repairs. And it really is a much better way of looking at things. And maybe right now, this first year, you say, no, I don't want to, but I will tell you, I think as people get used to the tax law changes, I think more and more people are going to end up turning their vacation homes into investment.
I wonder what that'll do for the economy. I don't know.
For the what?
Economy, I don't know.
What do you mean?
I don't know.
Well, if they're now renting out second homes that were vacant, people are going to now have more money. So she's thinking it will help people will spend more money. I think
maybe.
that's
Maybe.
Right. With that's hopefully.
But the bottom line is, if you got a second home, good luck, because it's not going to be deductible under the tax law. And then a lot of people say to me, is this really, is a change in the tax code good for the average person? I mean, it is definitely good for the upper income person. The average person, I mean, if you have children, then it's good. But the average person, I would say not so much. I mean, it's certainly just revenue neutral.
Right.
Yep. Yes.
Right?
I think I've found what you've said true. 1/3 of my clients benefit, 1/3 don't, 1/3 stay about the same. And
yeah, and that's really about a third are going to be unhappy, a third are going to be who cares, and a third is going to be really happy.
correct.
So it's a sad thing when a tax advisor says the best thing you can do from a tax shelter if you're a moderate income person is to have children. All right, let's go to the next question.
Okay, it has to be a fast one. My parents are 75 and 77, and they're talking about putting their house in my name. They are afraid of a nursing home taking it. Is this legal? Is there a different way? I don't need another house. Amy.
Yeah, is it legal? Yes, they can do that. You can put your house in whoever name. But is it the best thing? Not necessarily. I think they should look at a life estate. Would you agree?
I would agree, because if you gift somebody the house, it goes back to their original basis. And so that's what mom and dad originally paid for it, plus all their repairs and improvements, which a lot of times people don't keep track of all that. And so whereas if they inherited it or put into a life estate, you get that stepped up basis. So
You mean upon the sale? Mm-hmm. Right, and so that's the whole thing. At some point in time, mom and dad's house is going to be something that's going to sell, and when you sell it, and usually it'll be after the death of mom and dad, if she just gave it to you, then her basis becomes your basis. You're going to end up paying taxes on it.
Right, and that's
So
where
I would suggest a life estate.
Yep. Either way, I would try to sit down with mom and dad and try to get their cost basis, because if mom and dad sell the property before they pass away, that goes on your tax return and it goes back to the original basis.
Right.
So you do homework now rather than later.
Absolutely right. Okay, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side with your emails. Hi, I'm Esther Golias, the tax lady from EG Tax. Thanks for listening to us on WBEN News 3930. We are talking taxes and we're talking your emails. And if you have any questions for us, live phone calls, you got to wait till next week. But in the meantime, if you want to join us in studio and you want to email us your questions, you can go to our website at egtax.com. Ask the tax lady. You can email us, and you can be in a future show. And I have Tiffany Fabian and Christopher Fabian here with me. And what do we have next, Chris?
I've got Paul from Wheatfield. He says, EG Tax, I went to sell everything and move out of New York. My problem is that I owe a lot of property. My personal home, a small plaza, and 3 rental units. I assume the investment properties come to over $1 million in value. and my house 250,000. I inherited 3 of the rentals 4 years ago, and the plaza I bought back in 2000. I've looked at property in Texas and Florida, but I'd have to pay a lot of taxes. I won't have that much left. Well, I think of exchange. Some of
Okay,
them.
that's exactly right. That's what I would think of for sure. Why don't you explain what that means, Tiff?
So I would say that you need an immediate exchange person like Russ Gullo, and you have to exchange what you currently have for another property. Doesn't have to be of the same entity, doesn't have to be of the same value, and that way you don't have to worry about all the capital gain that's going to incur. You're going to take the property that you have now and exchange it for another one. You need a exchange person to work with you so that you declare
so
the item.
What people don't know is when they have rental property, every year you systematically write off the value of the rental property. And so over a period of time, the property you paid $100,000 for, after you've written it off, is only down to maybe a very small or zero basis. So if you sell it, you're going to pay taxes on the whole thing. That's what. But the cool thing about an exchange is you can take your zero basis or low basis asset and roll it into another investment property outside of the area, and you don't pay any taxes. And that's where Russ Gullo comes in, right?
That's right.
And so this way you don't pay taxes at all.
Right, you
And
postpone
you basically
paying.
get to start you get to have your investment in the next state, and you don't have to pay taxes. Now, and upon your death, your children get a stepped-up basis, so they don't pay taxes either.
That's I was going to say your favorite line: defer, defer, die.
Die. Yep. I mean, that's my tax planning strategy. I want to die out of this whole mess.
And then he has a house here, a personal house for $250,000, and if he's owned it and lived in it for the last 2 out of 5 years, and he's a single person, he doesn't have to worry about the gain unless it's more than $250,000.
Yeah, right. So his he can sell his house, and that's tax free. Then it says I inherited 3 rentals 4 years ago. So he really doesn't have that much depreciation to recapture, right?
No.
So really what he needs to do is take a look at if he sells it outright, what's the tax liability? His house is going to be completely tax-free. Or if he does an exchange, what his basis is going to be, because maybe he doesn't feel like getting into that much property where he's moving to.
Correct.
But I guess that just kind of goes with the territory. When we talk to people, we say, okay, if this happens, this is A, this is what's going to happen. This is B, this is what's going to happen. This is C, and you give people some logical facts so they can make their decision. Because maybe he doesn't want to be a big landlord in Texas or Florida.
That's right. That's right. And so you really want
And let's face it, in Florida, property values are a lot more expensive than Western New York, and so he might have to only buy or exchange for 1 or 2 properties. May not be what he wants to do.
And so there's always options, and so you want to make sure you figure out before you go right or left, you know what the answer is.
Right. Okay, What do we got?
Let's see. William writes in, I'm hitting the magic age of 70 and a half this year, and I know I have to do my RMD. My question, what will my tax burden be? I'm married. I am 70. My wife is 68. I have a pension of $24,000 a year. My Social Security is $25,000 a year. My wife has not started her Social Security yet. We're waiting till she hits 70. My minimum distribution is going to be $20,000 a year. Please help.
Wow, that's a lot of figures.
I'm a married 70. I have a pension of 24. Well, the first thing that jumps out at me is I hear Chris in the back of my brain saying, "Why is his wife waiting to get Social Security till she's 70 years old?"
Well, but let's let that go. Let's let that go because how old is she right now?
68.
Do we know?
68.
68. Well, she's already left 3 years on the table, so or 4 years, so. But okay, so he's got how much in RMD?
Pension $24,000 a year. His Social Security is $25,000 a year. His RMD is going to be $20,000. It doesn't say that his wife has any money from wages or pensions or 401ks. So the only, we've got 24,000 of his pension, his RMD is 20, and 25,000 a year in Social Security.
So we know 44,000 is taxable, and half of his Social Security is going to make it 85% taxable, right?
Right.
And that's the way it goes.
Well, not necessarily.
Okay, what are you talking about, Chris?
What if he does a QCD, a qualified charity
He
distribution?
could, not that many people are into charities, but if he wanted to, if he's somebody that gives money to charity, a great way to take advantage of the deductibility of the charitable deduction and fulfill your RMD is to roll over the money from your IRA into a charity, and then by doing that, your that charitable distribution will be qualified for your RMD, and it won't be taxable. So that's a great point for people who are generous.
Right. I had, believe it or not, I had Tim at our office had said, hey, I have somebody on the phone and they want to do a qualified charitable distribution, but the person that they deal with says, well, you're going to give it to too many charities. You have to open up a checking account with us, and then from that checking account, we'll do it. And I said, no, they just don't.
It's got to be a trustee to trustee.
Right. They just don't want to do all the paperwork.
Yeah.
If this was the case here, then if for William here, then you're talking that they're going to pay a lot of extra money and need to figure out withholding to do what to do because they're going to owe money on that.
So let's back up. To do a qualified charitable distribution from your IRA, let's say you're over the age of 70 and a half, you got to do your RMD, and you're somebody that consistently gives $8,000 or $10,000 to charity, and your RMD might be $8,000. You basically contact your administrator from your RMD, and you say, "I'd like to give it to St. Luke's," and they write a check to St. Luke's Charity that takes care of your RMD. And it's not taxable income. It doesn't make your Social Security it doesn't consider the Social Security taxability. And you have fulfilled your RMD and you've given to a charity. Yay for you.
And I have I have a handful of clients who do this every year, and it works out really nice. I think it's amazing. They take their RMD and they roll it over into a qualified charity distribution.
Right.
And
again, if you need help with that, EG Tax wants to help you. You can call us at our corporate office at 632-7886. If you don't know what the heck we're talking about and you give to charities and you're over the age of 70 and a half, you ought to give us a call because we'll be very happy to help you.
Right.
Right?
What were you gonna say?
Okay, what else we have here?
Wait.
Yes, sir.
Going back to the original, one of the things that Tiff brought up too, with me being in her brain, her Social Security, she may have 2 years left, but say she was supposed to get $15,000 a year, or for right now, and in 2 years she was going to get $17,000 a year. That's $2,000, but that's $36,000 she could have in her pocket now, which that $36,000 divided, you're still looking 18 years to 12. You know what I mean? So she's still going to have a long way to go to catch up. So I would still consider taking her Social Security now instead of later.
Oh, you're talking about Social Security.
Yeah.
I didn't. I'm
Yes,
thinking
you
like,
brushed right by that one.
Wait. Yeah, you're absolutely right, because for those of you that listen to Ask the Tax Lady, we say take the money now. They don't give it to you if you pass away. Mm-hmm. So
and a bird in the hand is worth more than two in the bush, and let it go into your investments
Right.
and start growing.
Right.
Because
Right.
like you said, the money's not there if you pass away. They don't hand it over to the husband or the wife.
all right. So in the meantime, if you're somebody that's lucky enough to get one of those love letters from the IRS or the state of New York, and you don't know what the heck to do, give EG Tax a call. We will help you to sort out the letter. As a matter of fact, one of my own clients. He was supposed to get a increased refund because his child went to college, but he didn't qualify for the credit on the federal. On the state of New York, they kept disallowing it. Well, that was because the Social Security number that he had provided me was incorrect. And so the state of New York didn't write him a letter and say, oh, gee, we think that your kid's Social Security number is incorrect. They just disallowed the deduction. So once we let the state know that here's the correct Social Security number, they're going to give the taxpayer like thousands of dollars back. And that happens all the time.
Right, but the way they worded the letter was like, I'm sorry, we're right. You're not going to get anything extra. But it didn't say to do anything.
Yep.
Right.
And
I had
so
a
that's
federal
the whole
letter like
thing.
that, too.
In the event you get a letter from the federal or the state, assume the letter's incorrect and that you have somebody else that'll stand in your and help you. And there's no charge. We don't charge you to help you with the federal or state. But until next week, I'm Esther Golias, the tax lady from EG Tax. We're joined in studio with Christopher Fabian, Tiffany Fabian. If you need the best tax help, and again, during the summer, we're your advocate. If you owe taxes and you can't pay them, we'll offer you the offer and compromise. Our website is egtax.com. Until next Saturday, I'm Esther Golias. Have a great week.